Remember the good old days, pre-internet, when stock market crash wasn't a daily headline? Then there's Peter Lynch, the Usain Bolt of investing, who zipped past market turmoil like it was a morning jog. But did you know he loved crashes? Yeah, mind blown. Today, we ditch the naive daydreams, dive into the real world of market meltdowns, and uncover how Lynch turned financial storms into shopping sprees. Welcome to Financial Literacy. Here, we are dedicated and passionate about bringing you nothing but honest and straightforward facts about your money. We will help you take control of your finances and get you to the next level. Beginners or experienced, this is your one-stop shop for all things financial literacy. In today's video, we are going to look at Peter Lynch's million-dollar strategies to profit from market crashes. There have been 93 mind-boggling years in our financial history where the market plunged at least 10%, with a mind-numbing frequency of once every 2 years. Out of these crashes, 15 noteworthy ones sent the market spiraling down 25% or even more. Now, in every dark cloud, there's that shiny silver lining, and for us, it's discovering opportunities within the crash. So fasten your seatbelts because we are about to discover how to capitalize on turmoil like a Wall Street Jedi. So if you're ready, then let's start the video. Number 1. Avoid trying to time the market. Who among us doesn't think of themselves as a financial psychic? We have all dreamt about being Wall Street superheroes by jumping into the stock market at its lowest point, taking advantage of amazing deals, and selling gracefully at its pinnacle. But even the Wallendas wouldn't dare try this kind of market timing, my dear audience. It's a dangerous venture. Imagine this for a moment. Mr. Lynch carried out an intriguing study, a financial circus, if you will. He saw two investors as two gears in the constantly rotating machine that is the market. Meet Mr. Lucky, the agile acrobat who was a master of market drops who made every purchase at the lowest point of the year. And then there's Mr. Unlucky. Heaven bless him, who always seemed to be sitting on top of the market, buying right before everything collapses. The results? The investor who just bought and held without any fancy footwork, Mr. Average Investor, did better than Mr. Lucky, even though his timing was perfect. Though there were a few snags along the way, even Mr. Unlucky, bless his soul, didn't fare too badly and made a reasonable return. This, my friends, is the real trick. Ignore the risky game of timing the market and the gymnastics of making future predictions. An easier and attainable path to wealth is shown by Lynch's research. Keep a consistent attitude to investing. Take a long-term approach, and let the market play out naturally. To reach your financial peak, it's like building a sturdy ladder instead of a risky tightrope. Number 2. The power of holding and buying more in crashes. So, you're in the market, right? You've bought a few stocks here and there, and then suddenly, the market crashes. Now what? Oh, right. You've got the tried and tested start panicking and sell everything strategy. Brilliant! But guess what? Our good old friend Mr. Peter Lynch has something to say about that. Remember how you licked your lips when your favorite shoe was on sale last month? Well, imagine the stock market just putting your favorite stocks on the biggest sale ever. That's what a market crash is. A chance to grab your beloved stocks at discounted prices. Why would you run away from that? You wouldn't sell your favorite sneakers just because there's a sale, right? So why do so many people panic and ditch their stocks when the market wobbles? Investing long-term is about believing in companies you dig, and let me tell you, some folks have mastered that like a barista crafting the perfect latte. Take Warren Buffett, the guy whose bank account could buy a small nation. In 2008, when the market crash turned Wall Street into a bakery on fire, everyone was desperately offloading their stocks like burnt cookies. But Buffett? He was happily filling his basket with gems like Goldman Sachs and General Electric. He saw the dip not as a disaster, but as a clearance sale on awesome businesses. Fast forward a few years and those discounted stocks fueled his wealth to stratospheric heights. Imagine that as soon as you enter a store you love, everything is half off. For smart investors, that's what a crash can be. This is your chance to acquire the businesses you've had your eye on and that you genuinely think will succeed in the long run. It is more important to comprehend the businesses and have faith in their potential than it is to make future predictions. Even though I'm not Warren Buffett, I'm simply passing on the knowledge of someone who became a millionaire at age 46. Even though the majority of us are still hoping to have a respectable retirement plan. So, put an end to your fear, perform due diligence, and view a market collapse as a second opportunity to assemble your financial future piece by piece rather than as an open sale. Though it won't happen right away, you might be surprised at what you can accomplish if you have patience and make wise decisions. Number 3. Understanding your investments. In the world of investing, clever minds are aware that a stock's eye-catching exterior should not fool them. It's not about lustfully staring off into the distance, a weeping Romeo captivated with Juliet's balcony. Instead, it's the knowledge of what powers the company's internal operations, rather than merely its slick exterior that holds the true magic. Think of it this way. Would you commit to someone solely based on their looks without peeking into their past, their values, their potential for both sunshine and storms? Of course not. Investing needs the same depth of understanding. Don't just fall for the charming logo or the promising ticker symbol. Delve into the company's financials, its business model, and its competitive landscape. This is where the real story unfolds, where you uncover the true potential, the risks, and the rewards. Investing solely in aesthetic appeal is akin to creating a stunning sandcastle on the shore that will surely collapse in the first wave. Real financial security arises from starting from a strong foundation and having a thorough grasp of the businesses you choose to invest your hard-earned money in. And here's another thing. Peter Lynch reminds us that panic is the enemy of sound investing. When the market takes a dip, it's crucial to remember why you chose those stocks in the first place. You did your research, and you believe in the businesses. Now's the time to trust your judgment, not succumb to the fear. Peter Lynch's mantra is simple yet powerful. Understand the companies you invest in, hold on to them when the going gets tough, and consider adding more if the fundamentals remain strong. It's not about blind optimism, but about informed confidence. Of course, the choice is yours. You can stick to the "I know nothing, but I'll pretend I do" soup and hope for the best. Or you can heed the wisdom of someone who turned millions into billions. Remember, the market rewards patience and discipline, not panicked flailing. You can always count on market crashes to spice up your investing life a bit, don't you think? But you can be a rock star in the investing world knowing these insights from Peter Lynch. So that's everything for this video. What are your insights? We would love to read them in the comments below. And here's my last question for you today. So with all of this, are you ready for the next market crash? Say it with me now. Absolutely. Thank you for watching. If you like this video, please don't forget to give a thumbs up, comment, and hit that notification bell so you don't miss out on our following videos.